Welcome to week 2, part 2 of our live chat for finance 4126, financial decision making and planning. I'm Dr. Mark Dennis, certified financial planner professional, and today we're going to build on your final project a little bit more by exploring the following key topics related to home ownership, which include mortgage planning, credit scoring, and insurance. These topics are essential for crafting a strong financial plan for our hypothetical family, the Zimmermans. Let's dive right in. When preparing your final project, think of this outline as a blueprint. You'll cover the Zimmermans' financial goals, analyze their current financial position, and work through planning elements like cash flow, taxes, investments, risk, and retirement. Also, be sure to include any special situations, employee benefits, and education planning. A comprehensive plan ties all of these pieces together. In some instances, you may not have as many details as you would like. This very much simulates the real world where clients don't often come forth with all the details you might need. In those cases, feel free to make some reasonable assumptions, but be sure to explain those assumptions in your final report. Purchasing a home can include some major tax advantages. For example, mortgage interest and property taxes may be deductible, and when the home is sold in the future, up to $250,000 of capital gain per person, or twice that amount, $500,000 for a married couple, is excluded from capital gains taxes if the home was their primary residence for at least 2 out of the previous 5 years. Any improvements they've made will add to the cost basis, further reducing the capital gains that would be due when they sell. This particular tax break can be used once every 2 years. How much home the Zimmermans can afford depends on several things. Higher income, as well as a larger down payment, both support larger home purchases. Being in a higher tax bracket also increases the value of any available deductions. And if they've built up liquid assets, or if they can make that strong down payment, they're going to face fewer monthly cash flow demands. However, any current debts they have not yet paid off could severely limit affordability. Looking beyond the math, emotions and personal values also matter. If homeownership is a priority, many families find ways to sacrifice in other areas. Local market prices also vary widely, and if the Zimmermans are optimistic about future income or real estate appreciation, they may indeed stretch their budget. However, their risk tolerance will ultimately shape what mortgage payment feels comfortable. Homes can be a solid long-term investment, especially when you factor in potential tax benefits as well as price appreciation. However, they are definitely not liquid. Maintenance responsibilities and market volatility are also drawbacks. Plus, with today's higher standard tax deductions, many homeowners get no real additional tax benefit simply from owning a home. The bottom line? Don't let the tax tail wag the financial dog. Consider the home as a place to live as well as an investment, and perhaps not so much as a tax shelter. find out if the Zimmermans are truly ready to make this purchase, you will need to carefully evaluate a couple of their financial ratios. These ratios measure their liquidity and their ability to manage debt. You'll be pulling data from their personal balance sheet and cash flow statements in order to develop some meaningful insights and compare them to what represents a healthy financial set of benchmarks. Here we see an example of how to calculate the current ratio. The current ratio tells us if the Zimmermans have enough liquid assets to pay short-term liabilities. A ratio above 1.0 is healthy. Ratios below 1.0 suggest that they probably have some serious trouble with meeting obligations as they come due. However, credit cards and payment flexibility can sometimes hide deeper elements of financial strain. The Zimmerman's emergency fund ratio is also extremely important. This ratio looks at how many months of critical living expenses the family can cover using only their liquid savings. No credit cards, no 401k loans. This must come from a balance of cash. A 3-month cushion is the standard, but if their income or their expenses are unpredictable, they might need more. The recommended range for an emergency fund is anywhere from 3 to 6 months of regular critical expenses. This is super important anytime they decide to take on new debt, like a mortgage. When the Zimmermans are ready to apply for a mortgage, including an application for mortgage pre-approval, a lender will begin by pulling their credit report. When looking at their credit history, this will include not only credit usage, but also the calculation of a credit score, sometimes known as the FICO score or the Fair-Isaacs score. The higher this score, the better the loan terms. Some key factors affecting their credit score will include payment history, credit utilization, the age of their credit accounts, and any new credit inquiries or fresh credit applications. In order to qualify for a home mortgage, the Zimmermans likely need a credit score of between 620 and 640 at a minimum, but for the best rates, they should aim for a score of 740 or higher. This makes it vital to review their credit early and fix any errors before applying for the mortgage. To improve their score, the Zimmermans should focus on paying all bills on time, reduce their credit utilization, which means paying off existing balances as much as possible, nor should they open any new accounts just before applying for the mortgage. They should, however, keep any older accounts open, as the length of credit history, assuming there are no late payments, will contribute positively to their credit score. Even modest improvements can lead to better mortgage offers. The number one way to improve someone's credit score is to always pay on time. The second best way to improve credit scores is to pay off existing balances, particularly high interest rate credit cards. A mortgage is a loan that is secured by the home itself. The home acts as collateral for the loan. As we discussed earlier, mortgage interest may be tax deductible on amounts borrowed up to $750,000. Agencies like Fannie Mae and Freddie Mac help support lenders by purchasing loans, while the Veterans Administration and the Federal Housing Administration offer mortgage insurance for qualified buyers. The mortgage process starts, of course, with a loan application. The lender will look at employment, income, credit, assets, and liabilities. In fact, the lender will look at everything. Think of the mortgage application process as something like a full financial physical. They also require a home appraisal to ensure the property being purchased is worth the requested loan amount. Keep in mind, with a mortgage, the home is the collateral for the loan. If everything checks out, the lender will issue a document known as a loan commitment. The buyer may also choose to pay some money up front in order to lock in the interest rate, or they can roll the dice and go with market fluctuations. Next comes a home inspection, a title search, and coordination with the closing attorney. At closing, the title transfers and the final loan terms are signed. At that point, the Zimmermans will own their new home. Borrowers may elect to pay points as a way to reduce the interest rate. Usually 1 point equals 1% of the loan amount. These points may be deductible in the year of purchase for first-time home buyers, or they can be amortized over time for others. Mortgage points are essentially a form of prepaid interest that borrowers can choose to pay upfront in exchange for a lower interest rate and lower monthly payments. This is a practice known as buying down the interest rate. In some cases, a lender may offer the option to pay points along with, well, let's rephrase it this way. In exchange for each point you pay at closing, your mortgage will be reduced and your monthly payments will shrink accordingly. Most mortgages are amortizing loans. This means the payments stay level, but the mix of interest and principal will shift over time. Early payments are mostly interest. Later payments are mostly principal. The common terms for a mortgage are 15 or 30 years. Let's assume the Zimmermans borrow $200,000 at 7% for 15 years. Their monthly payments would be around $1,798. Most of that is interest at first, but over time they begin to build equity through ever-increasing principal payments. Notice how, in this example, during the early years of a mortgage, most of the payment goes toward interest on the loan, with very little going towards paying down the original principal amount that was borrowed. If you intend to make extra principal payments on a mortgage, it is most advantageous to do so during the first half of the mortgage term, when you can save the most on future interest payments. So the Zimmermans might consider prepaying some of their mortgage payments early on. This will certainly save some interest, but it comes at the cost of reduced liquidity. If they could earn more by investing elsewhere, it might not be the best move. Think of it this way: if the mortgage interest rate is 7%, making an extra principal payment saves them 7% in interest on the amount paid. As an alternative, could they instead invest that extra mortgage payment somewhere else and perhaps earn more than 7%? This is a tricky question unless mortgage interest rates drop back down to 3 or 4%. In that case, even with stock market investment risk, it might be a better idea to invest the extra money instead of making additional mortgage principal payments. On the other hand, the extra mortgage principal payments are a guaranteed result. There are no guarantees with stock market investments, at least not in the short term. This is all about risk and opportunity cost and should be weighed carefully. Types of mortgages. Fixed rate mortgages offer stability. These are great for risk-averse buyers. Adjustable rate mortgages, or ARMs, offer lower initial rates, but these can rise significantly over time. ARMs are best for short-term homeowners or those who are seriously expecting interest rates to drop. This chart summarizes key mortgage characteristics. Be sure to analyze this as part of your project. The Zimmerman family's decision should reflect their financial situation, their time horizon, and their tolerance for interest rate risk. With greater financial responsibility, a family, a mortgage, other debts, and other goals, comes greater financial risk, which means greater risk of financial catastrophe. Insurance, however, is a risk transfer tool. For a fee, the insurer will absorb risk that could otherwise derail a household financially. Insurance underwriters evaluate the risk and charge accordingly. Consider for a moment the theory of an efficient insurance marketplace. In a perfect market, you would pay only the expected value of any future losses. But that's not reality. Insurance includes overhead, profits, and inefficiencies, all of which can drive up the cost above what you're likely to lose. Key inefficiencies when it comes to insurance include overhead costs and, in particular, something called adverse selection. This is where riskier individuals tend to buy more insurance, and then another factor called moral hazard occurs when people with insurance choose to behave more recklessly, precisely because they purchased the insurance. There are also behavioral factors and search costs that make choosing insurance a fairly complicated process. The Zimmermans may need several types of personal insurance coverage: life insurance, disability, long-term care, health insurance, homeowners, auto, and personal liability. Make sure your proposed plan addresses what coverages they already have, as well as which coverages are missing and what they should do about that. Be sure not to overlook different types of government insurance coverage. Social Security, unemployment, Medicare, Medigap, and Medicaid all play potential roles, especially as the Zimmermans get older. Think of these backstops as part of their broader risk management plan. This is an opportunity for you to shine. What gaps do exist in the Zimmerman's insurance coverage? Are they underinsured in any area? Could long-term care or disability coverage improve their financial resilience? Be sure to include your recommendations as part of their plan. This brings us to the end of part 2. These topics, home buying, mortgages, and insurance, are foundational to good planning. Be sure to apply these concepts thoughtfully as you complete the Zimmerman's case study. And as always, reach out with questions anytime. Thanks for tuning in.